So there's a saying that risk comes from not knowing what you're doing. I've analyzed hundreds of real estate syndications across multiple market cycles, and I've seen the winners that performed well and the deals that collapsed under poor management. And through all of those deals, there are 5 avoidable mistakes that showed up over and over again. And in this video, I'll break down the 5 mistakes that kill real estate syndication deals and how to avoid them so that you can evaluate syndications like a professional investor. If you're new to the channel, I'm Santiago. I'm a professional investment analyst, and I help high-earning professionals learn to invest like the top 1%. Most investors chase the deal's promise. They focus on the pro forma, the location of the property, the projected returns, the tax benefits, blah, 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 blah. But I will tell you right now, the most important determinant of a syndication's outcome isn't actually the property. It's the person running it, also known as the general partner or the sponsor. This is the first mistake I see investors make, is choosing a bad general partner. I'll tell you, a weak sponsor can ruin even a great property deal, while on the other hand, a strong, experienced sponsor can salvage even a mediocre deal. Investors often get way too distracted by the asset and fail to properly vet the operator. Investing in a syndication without first vetting the operator is like boarding a plane without checking the pilot's credentials. So let me list out to you the most actionable vetting steps that you can take to look at a general partner. And it's 3 things. First, you want to focus on their track record. Second is transparency. And third is alignment. You need to see a proven history of successful exits across multiple market cycles. It's just not good enough for the general partner to have only invested in an up real estate market. That doesn't tell us very much. You need a sponsor who also communicates openly about both wins and losses. I've came across so many sponsors that throw around these winning track records and say, I've never lost investor capital and I have 30% returns. But I'll tell you right now, even the greatest investors, including Warren Buffett, have losses. That's why transparency is key. When times get tough, how willing is the sponsor to own up to their mistakes and answer to investors and not run from it? But beyond that, there's one important question that we all need to ask about vetting our sponsor, and that's, how do they get paid? Are their incentives aligned with yours, the investors? You need to dig into the fee structure and understand what's driving the general partner and their payment system. If the fees are front-loaded in the investment, their motivation to maximize the final sale price lowers tremendously. So we want our sponsors to get paid, but there needs to be a fair and balanced fee system that aligns both parties. So choosing the wrong general partner guarantees your syndication will fail before the first rent check is even collected. I promise you. The deal's fate is often sealed the moment you wire that money to the sponsor. And if you don't do a good job at vetting the sponsor, you're setting yourself up for a world of hurt. So your first filter must always be the jockey. But trusting a sponsor's reputation isn't enough. There are so many sponsors all claiming success in their investment strategy, so you must verify their claims, and that verification starts with documents investors often just skim through and never even read, and that's the investment's legal Bible, the PPM, and the LPA, the Limited Partnership Agreement. This brings us to our second key mistake, and that's not reviewing and understanding the investment terms that are found in both the PPM and the LPA, the Private Placement Memorandum and the Limited Partnership Agreement. These documents are the Bible of the investment. A red flag appears when a sponsor is hesitant to share you these documents or tries to rush you through these documents like they don't matter. A good general partner will be patient, and they will walk you through each section to ensure you have a clear understanding, and they will even provide financials or past deals of their business. The limited partnership agreement dictates the entire financial relationship between you and the investment manager. It reveals exactly how profits are allocated between you and the sponsor, what fees exist, what legal protections you have as a limited partner, so on and so forth. And you must read and understand and challenge the terms before you wire the money. This is your primary legal protection. So what specific red flags in these documents should you be looking to avoid? So first, you want to look for a low or non-existent general partner co-investment. Think about this. If the sponsor has this great real estate deal, but they're not even putting up their own money, or they have a very low commitment and they're just collecting a bunch of investor capital, that doesn't align the interest very much. And you can find this sponsor agreement in these legal documents. How much capital are they putting up at risk, and what is their commitment level to this property? You also need to scrutinize the fee structure for excessive charges that are often hidden and buried in these documents. I'll tell you right now, these documents are hundreds of pages of legal mumbo jumbo, but you need to come through them and understand these things. There are hidden fees, like a quote unquote marketing fee, that may state that they can charge a certain amount just on marketing, and you need to know that amount. And be wary of the payout structure that over rewards the sponsor too early in the deal, like we mentioned before. You want the sponsor to be incentivized to perform all the way through the deal, and this legal boundary of how they have to perform and how they get paid are all listed in these legal documents. And finally, you need to check if there's any conflict of interest buried in the disclosure. And a good one that I always like to challenge sponsors on and figure out is that a lot of times the sponsor will own multiple companies that are associated with the deal. A really good example is they might own a property management company, and the investors may be paying the property management company through the investment terms. They might say, hey, we're going to acquire the property, but we're going to pay the property management 10% of the revenues. And in essence, this isn't a bad thing, but investors need to know what they're paying and how they're paying it to get the structure of the investment, and also understand the conflicts of interest that may exist. So even if you have a great general partner and you clearly understand all the terms in a legal document, the future of any investment remains unknown. We don't know what's going to happen with the investment success. So the next mistake is failing to prepare for uncertainty by neglecting to stress test the deal. So before we continue, if you're finding value on this information and finding it helpful so far, do me a favor, like and subscribe to the channel so that I can keep delivering more content just like this, and drop a comment below on what you would like to hear about next. So let's get back to stress testing. Every deal looks great on paper when everything goes right. But I'll tell you right now, every deal on paper never pans out like it does on paper in real life. So the third mistake is failing to give a proper stress test. And you might be asking, what is a stress test and how do I do this? So let's break this down. You must ask the tough what if questions that often just get glossed over. The conflict is that projections frequently assume the best case scenario. So they'll say, we're going to raise rents by this much, and we're going to stay under budget, and expenses are going to remain flat, and it's all going to work out. And the purpose of stress testing is not to try to predict the future, but is to ensure that a proper margin of safety exists that buffers and protects your investment if market conditions begin to deteriorate. So let's take a specific scenario and walk through this. What happens if the market rents go down by 10%? Do you know how this affects the investment? What if the property's occupancy drops to 80% and it stays at 80% for 6 months? Good way to think of this is if you've ever drove down the road and you see those signs that are hanging outside of apartments that say you get a free month's rent or 2 free months rent or move-in ready without any money down. Do you think that they're just doing that because they're nice people? These are things that you need to be thinking about. And a pro forma that you get from the investment manager will always present a base case that often leaves out the worst case scenario. So your goal is to see if the projected returns in a downside scenario remain consistent and in an acceptable range, even if it doesn't pan out like it does on the paper. And if the deal collapses with a minor setback, It was built on a weak foundation to begin with. So let's walk through some specifics on how you can stress test. So you need to go to the projected income statement that they give you. You need to take all the cash inflows. So this primarily will be the rental income, and reduce them by a fair percentage, say 10 or 15%. You're going to reduce that monthly income. Then simultaneously, you're going to increase the cash outflows. Cash outflows might look like maintenance, property taxes, insurance, and you're going to reduce them by that same percentage. You're going to increase them by that same percentage. Increase your outflows. And this simulates a tougher economic environment, and then you can recalculate all the key investment metrics to see how the investment pans out. So you are looking at the conditions that must exist for this investment to just simply break even. If the break-even point is unrealistic or highly optimistic, then the deal lacks a proper margin of safety that allows you some wiggle room if things don't pan out. And this analysis will reveal the investment's true resilience. But I will say, one of the most powerful levers that are going to be in this portfolio when you're stress testing that will affect the resilience is the source of the debt and how that debt is structured. So debt can magnify profits, but it also can devastate the returns, and the difference is in the terms of the debt and how it's structured. Debt is the heartbeat that determines a deal's financial success. It all comes down to the debt. In recent years, there were a lot of operators that had an over-reliance on high leverage loans that left many syndications dangerously exposed when interest rates rose sharply. These deals faced massive refinancing risk, and the timeline and the structure of their loans can save the deal or sink the deal in tough times. Most syndications that you're going to run across use interest-only loans with a term of 4 to 5 years. And so their business plan hinges on improving the property's value and cash flow, getting it up to speed, getting higher rent prices, and then securing new or favorable loan conditions after the current loan runs out after 3 to 5 years. But if the general partner cannot refinance after that loan term is coming to an end and that loan matures, the consequences to investors can be severe. And I've seen this time and time again. I've seen so many syndications fail entirely just simply because of the debt terms. So the property might be performing well. You might have a good thing going, but if the capital markets are frozen or rates are going higher than when you bought the property originally, the deal can easily break if you're not paying attention to the debt terms. And so if a floating rate debt loan is issued, it must have an interest rate cap to limit your exposure. So you must also ensure that the loan terms comfortably align with the business plan's projected timeline and their cash reserves. They need significant cash reserves that if they're not able to refinance or exit when they plan, they can continue to service the property properly. And irresponsible debt terms can break a deal no matter how good the asset or sponsor appears. The debt introduces a level of financial risk that can overwhelm all the other positive factors if this is not structured correctly. So even if you master all the first 4 mistakes that we talked about, it all means nothing if you fall into this one trap that can undo all of your discipline. Investing is not a volume sport. There is not 100 good deals a year, I promise you. This introduces the 5th and final mistake I see investors make, and that is the fear of missing out. You make rushed decisions that are driven by emotion, and that can crash everything for you. There is an internal conflict in all of us that feels like we're going to miss out on the perfect deal, and we let the crowd's excitement or an artificial deadline or pressure that you're putting on yourself to make you get into unacceptable risk levels and unacceptable deals. I can't tell you how many times I've seen real estate sponsors or real estate investors, they say, I have to get into this deal within the next 4 days. And I think to myself, well, if you miss this investment in the next 4 days, is that really going to change anything? Is that going to make or break your portfolio? And chasing every opportunity that comes your way is just like a surfer that's trying to catch every wave, right? You cannot catch everything. You end up exhausting yourself out, and in the process, you might end up missing truly great deals, focusing on every single deal that comes your way. The professionals understand that patience is a weapon. They wait for the right conditions, and to combat the fear of missing out, they establish a personal deal cadence. They decide in advance how many investments they will realistically make per year, and this forces you to be highly selective. You must demand that every single potential deal pass through a rigorous vetting process that you've set up. You must become consistent and even satisfied with passing on deals that fail to meet your clear, defined standards. Mastering your vetting process is going to matter more than finding this mythical perfect deal, because I'll tell you right now that the perfect deal just simply doesn't exist. Every single real estate deal or investment carries some level of risk, and creating a repeatable process for identifying and avoiding these mistakes that we've talked about today creates the consistency and long-term success in your portfolio. So let's go through the 5 mistakes once again. You have the bad sponsor, the bad GP, the unread documents, the untested assumptions, the dangerous debt, and the emotion of fear of missing out. These 5 things are consistently what kill real estate syndication deals. So by creating a process to check and balance these mistakes is what separates the amateur investor from the professional investor. So building your process out is what's going to create your consistency, and you will find real estate syndications that can perform exceptionally well if it's done right. Your patience will be rewarded, your discipline will be rewarded, and you'll feel much better going into the investment with a careful vetting process. So if this framework helped you out, do me a favor and click the link in the description to join my email list. And don't forget to like and subscribe to the channel and leave a comment on what your experience has been with the real estate syndications. And now that you know the 5 mistakes that kill real estate syndication deals, go ahead and check out my video that'll be linked above so that you can learn how to start building passive income using alternative investments.